Financial statements provide a detailed snapshot of a company's financial health, but they can also be manipulated to conceal fraud, mismanagement, or financial distress and warrant further investigation. Recognizing these red flags early can help businesses prevent financial misstatements and regulatory penalties. One of the most obvious red flags is inconsistent or unrealistic financial results. Companies that report unusually high revenue growth without a corresponding increase in cash flow or expenses may be manipulating their earnings. Sudden fluctuations in revenue or profit margins that don't align with industry trends can also indicate that financial results have been artificially inflated. Auditors compare financial performance over multiple periods to detect patterns that may suggest fraud or aggressive accounting practices. Unexplained adjustments or excessive journal entries are another area of concern. Adjusting entries are normal, but frequent last-minute adjustments, especially those made near the end of a reporting period, may indicate an attempt to manipulate financial results. Auditors pay special attention to entries made by unauthorized individuals or those lacking clear documentation, as these can be used to conceal fraudulent transactions. Another common red flag is discrepancies between financial statements and supporting documentation. For instance, if a company's reported sales figures do not match corresponding invoices or bank deposits, it could signal false revenue recognition. Similarly, mismatches between accounts payable and vendor records may indicate hidden liabilities. Auditors conduct reconciliation procedures to ensure that financial statements accurately reflect a company's actual financial activity. Irregularities in cash flow are particularly telling. A company might report strong earnings while struggling to generate cash, which could suggest that revenue is being recorded prematurely or fictitious sales are being created. Negative cash flow despite reported profitability is a classic warning sign of potential financial misrepresentation. Auditors analyze cash flow statements alongside income statements to detect inconsistencies that could point to underlying financial instability. High levels of related party transactions can also raise concerns. While not inherently fraudulent, transactions between a company and its executives, shareholders, or affiliated entities can be used to shift profits, hide liabilities, or engage in self-dealing. Auditors carefully examine the terms and legitimacy of these transactions to ensure they are conducted at arm's length and properly disclosed. Unusual increases in inventory or receivables without a corresponding rise in sales may indicate that a company is overstating assets. Inventory buildup could suggest that obsolete or unsellable stock is being kept on the books to inflate asset values, while rising accounts receivable without collections could point to fictitious sales. Auditors assess inventory turnover ratios and aging reports to determine whether these figures are realistic. Management's reluctance to provide information or excessive complexity in financial reporting can also be a red flag. If company executives delay document requests, provide vague explanations for discrepancies, or create overly complex financial structures, it may indicate an attempt to obscure financial realities. Auditors remain skeptical of overly complicated financial statements that lack transparency or appear designed to confuse stakeholders. By identifying these red flags, auditors help protect businesses, investors, and regulators from financial misstatements and fraud. Companies that proactively address these risks through strong internal controls, regular audits, and transparent reporting practices can reduce their exposure to financial misconduct.